Hey everyone, welcome back to Corporate Dakota, the place where we decode the corporate world. Today we're diving into a report from the Bank of New York Mellon, and trust me, it's not as boring as banking usually sounds. We'll see if their plans to boost dividends and manage their capital are a stroke of genius or just shuffling the deck chairs. Want more straight to the point insights from corporate documents? Make sure you're subscribed. We also have a Discord community linked in the description below for even more discussions with smart people like you. This report, dated July 1st, 2025, gives us a snapshot of what's happening at the Bank of New York Mellon, or BNY Mellon as it's often called. It's like a financial weather report telling us what's up with their money and plans. The main thing to note is that BNY Mellon is planning to increase its quarterly dividend. That's the payment they make to shareholders by 13%. It's going from $0.20 full raise for FRA 30 cents per share. Think of it as a small raise for everyone who owns a piece of the company. This boost is supposed to start as early as the third quarter of 2025, but needs their board of directors to say yes first. Another key detail is about something called the Stress Capital Buffer, or SCB for short. This is basically extra money the Federal Reserve, the US's central bank, requires them to have on hand as a safety net in case things go bad. It seems like BNY Mellon's requirement will stay at 2.5%, which is the minimum. So they're not being asked to hold any extra cash beyond the base level. This SCB number is expected to be good from October 1st, 2025 to September 30th, 2026. Next, let's talk about stock buybacks. BNY Mellon is authorized to buy back its own shares. This is like the company investing in itself. When a company buys back shares, it reduces the number of shares available in the market, which can push the price up, making each remaining share more valuable. They can do this in a few ways, like buying shares on the open market, negotiating private deals, or using special plans, including some complicated financial arrangements. What they actually do and how much they buy back depends on how much cash they have and what the market looks like. Now, there's a possible change coming from the Federal Reserve about how to calculate that stress capital buffer we mentioned earlier. The new method they're thinking about involves averaging the biggest drops in their capital during the Fed's made-up stress test scenarios, plus adding in dividends. This new rule would also change when SCB gets updated, moving 20 after and Joe this is still just a proposal in April. BNY Mellon doesn't think it will actually change their SCB requirement. The company's SCB has stayed at the 2.5% floor since it started back in 2020. The report also has some safety language, what they call forward-looking statements. These are basically guesses or predictions about the future. They talk about things like buying back shares, paying dividends, their financial health, and dealing with regulations. But they're saying it's not a guarantee because lots of things could change. These factors include the company's capital, prevailing market conditions, which means how the market is doing in general, and what the regulations are. If you want to dig deeper into these risks, you can check out their annual report from the previous year and other filings with the Securities and Exchange Commission, SEC, the government agency that oversees companies. Now, overall, what do we make of all this? BNY Mellon seems to be sending a message of stability and confidence. Looking at these announcements, there are a few key strengths. First, increasing the dividend is a way of rewarding shareholders. The 13% increase is a good sign, suggesting they are making enough money to share. Plus, keeping their stress capital buffer at the minimum shows they are meeting regulatory requirements without needing to hold extra capital. This gives them more flexibility with their money. It covered near-over. There are also some potential concerns. The stock buybacks, while good for boosting the stock price, also mean that the company thinks its stock isn't super valuable right now. Also, the ever-changing regulations from the Federal Reserve, while it isn't currently impacting them, could be disruptive to their business. In conclusion, BNY Mellon seems to be stable and they're rewarding their shareholders. While they face the same economic risks as every other company, they seem to be handling them well. Alright, that's our breakdown of BNY Mellon's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.